What if I told you that a single, simple form you forgot to file could end up costing you 28 lakh rupees? It sounds absolutely insane, right? But for a lot of Indians earning money from abroad, this isn't just a scary story. It's a very real, very painful financial trap. Today, we're going to take that trap apart piece by piece. Just look at that number, 28 lakh rupees. That's not some random figure I pulled out of thin air. It's the actual cost of one tiny administrative mistake, paying your full tax in India on income that you already paid tax on in the US. It's a huge, costly error, but here's the good news. It is completely 100% avoidable. So what's the root of this problem? Well, it turns out a massive number of Indian residents who have foreign income are, getting taxed twice on the exact same money. The crazy part is, a solution has been on the books for decades. We're talking about a treaty signed all the way back in 1989. The problem? Most people just have no idea it exists, or if they do, they don't know how to actually use it.
And that brings us to what we call the double taxation trap. It's exactly what it sounds like. It's this financial pincer move where two different countries both decide they have a right to tax the very same slice of your hard-earned income.
Here's how the trap works, and it's brutally simple. Let's say you earn a salary or get some dividends from the United States. The US, which is the source country, is going to take its cut. But because you're a tax resident here in India, the Indian government also wants to tax your global income. And yep, that includes the money you just made in the US. So what happens? You get two different tax bills for the exact same income. So how in the world do you fight back against this? Well, you have a shield. And that shield is a surprisingly simple document called Form 67. This form is your key. It's what unlocks the protective power of something called the India-US Double Taxation Avoidance Agreement, or DTAA for short. The DTA gives you this incredible tool called the Foreign Tax Credit, or FTC. Now, it's not a tax exemption, so don't get that confused. The best way to think about it is like a discount. Basically, Section 90 of the Income Tax Act lets you shrink your Indian tax bill by the amount of tax you've already forked over in the US. And that is exactly what Form 67 is for. Honestly, just think of it as the official receipt you show to the tax folks in India. It's your proof. It's you saying, hey, look, I've already paid my taxes on this income over there. Now please give me the credit I'm entitled to. It really is that straightforward. Okay, enough theory. Let's get down to the brass tacks. How do you actually calculate this credit and put that money back in your pocket? Okay. Pay close attention, because this is the golden rule. You have two numbers you need to look at. First, the actual tax you paid in the foreign country. Second, the tax you would have to pay in India on that same foreign income. Your foreign tax credit is always the lower of those two numbers. If you only remember one thing about the calculation, make it this. Let's run the numbers so you can see how powerful this is. Let's say your foreign income was $120,000. That's almost a crore in rupees. You paid about 23.33% tax in the US, which comes to over 23 lakhs. Now in India, the tax on that same income would have been close to 30 lakhs. So following the golden rule, you claim the lower amount, the 23.24 lakhs you paid in the US. And just like that, your tax bill in India plummets from almost 30 lakhs to just 6.4 lakhs. I mean, the savings are just massive. All right, to make this claim, your paperwork has to be absolutely perfect. Here's your checklist. Number 1, Form 67, and you have to file it online before you file your main income tax return. Super important. 2, a tax residency certificate, or TRC. This is the official proof of which country you're a tax resident of. 3 and 4 are pretty obvious, proof that you actually paid the tax, and a copy of your foreign tax return. Number 5 is Form 10F, another online form you need to claim treaty benefits. And finally, your bank statements. Getting these 6 things ready ahead of time is absolutely non-negotiable. Now, what happens if you've already messed this up, or what if you just forget to file on time? Let's talk about some of the common pitfalls, and more importantly, some major rule changes that are coming that are designed to make this whole process a lot more strict. Go ahead and circle this date on your calendar, April 1st, 2026. This is when the new Income Tax Act of 2025 kicks in. And trust me, this isn't just a minor tweak, it's a pretty big overhaul that's going to fundamentally change the rules of the game for claiming your foreign tax credit. So what's actually changing? Well, right now, with Form 67, it's pretty much a self-declaration. You say what you paid, and that's it. But starting in 2026, Form 67 is becoming Form 44, and it comes with a huge new catch. If your claim is for more than 1 lakh rupees, you will need to get it verified by a chartered accountant. This is a big deal. It adds a whole new layer of scrutiny and basically ends the era of simple self-declaration for any significant claims. So what if you missed the deadline in a past year? Don't panic, all is not lost. You might be able to file a revised return or apply for what's called a condonation of delay. Looking ahead, though, the system's just getting more formal. For example, there's a new Form 45 coming. This one is for when you finally settle a tax dispute overseas. See, you can't claim credit for tax you're still fighting about, but once it's all settled and paid, Form 45 will be the official way to go back and claim that credit.
Okay, that's a lot of information, I know. So how do we make sure you're protected? Oh, and here's a quick but important point. If you have income from, say, 2 or 3 different foreign countries, you have to do this FTC calculation separately for each one. You can't mix and match. All right, let's pull all of this together into a clear, simple action plan.
If you walk away with nothing else, please remember these 4 things. Number 1, timing is everything. Always file Form 67 or Form 44 in the future before you file your main ITR. 2, the golden rule of calculation. The credit is the lower of the 2 tax amounts. 3, get organized. Get your documents together early so you're not scrambling. And 4, look ahead. If your claims are over a lock, start thinking about that new CA verification rule now.
And that really brings us to the bottom line. You worked hard for that global income. The only question left is, are you doing everything you need to do to protect it from being taxed into the ground?